Good morning, everyone, and welcome to the MFC Group's FasTech Seminar Series. Today's special event is a tech market update with Dennis Reed. And just a few housekeeping items before we get started. The session is scheduled for 1 hour and everyone is muted, so please feel free to type any questions you may have into the chat. We'll monitor those and address them during the Q&A at the end. We are recording the seminar and we'll send out a link to the recording and the slide deck to everyone attending in the next few days. Now I'd like to hand off to Mike Swenson, President of MFC Group.
Thanks, Robin, and good morning, everyone. We're excited. This is back by popular demand. We've hosted Dennis before, and the sessions have been very well received. We thought the timing of this would be really good as we finish out the year and we look at what's going to happen in 2024. We have to make some assumptions, I think, with various things going on, economy, geopolitical. But Dennis has really good perspective, we think, in far as where's the market been and where is it going. This FasTech seminar series hosted by the MFC Group is really intended to get good information out, whether it be technical, market information, what have you, to our business partners. And that includes distributors, customers, suppliers we work with, and industry associates. So we've got, I think it was over 100 today. So we've got a big group. We'd love to see that. And I think, Dennis, you would say, too, if you have a coworker that missed today, we're very okay with you getting the recorded session out when Robin gets that out to you, to other people, if you feel they benefit from that. We love Dennis because he's one of the best, more real-time analysts I know. He knows what's going on. He's got a real knack for really being on top of any directional shift. So with that, I'm going to turn it over to you, Dennis, today, and let you get going with the presentation. Thanks.
Thank you very much, Mike. Thank you, Robin. Thank you, everybody at the MFC Group. It's always an honor and a privilege to speak with you. As Robin mentioned, before we get started, all questions, please feel free to direct them into the chat box, and they will be filtered through. Likewise, if you feel more comfortable, please feel free to email me directly, dennis@edgewaterrc.com. I will be able to monitor those real time as well and get to the questions. So just to start, what are we going to talk about? So I'll provide a quick, brief introduction in who we are at Edgewater and what we do. We'll talk about, where we are in the cycle. We're obviously clearly past the peak, but where we are and more importantly, kind of where we see us going and what this cycle looks like. Then we'll touch briefly on just some of the disruption that we've seen throughout the industry and kind of an outlook going forward. And then we'll drive deeper into both a supply side and demand side before concluding with kind of our outlook by the key segments of semis, or growth rates for semis, interconnects, and then the passive marketplace as well. So to start, who are we at Edgewater? We're an independent research company. We specialize in technology, internet, and then consumer and e-commerce research. And when the company was formed in 2018, at the core of our process was really consumer and then hard tech or component. And our thought was having a holistic view from calling it sand to silicon through the channel all the way to at least a B2C transaction. And then as we've evolved as a company and as the industry continues to evolve, we quickly identified that the internet was growing in importance to those verticals. If you look at it from a consumer standpoint, the likes of digital advertising growing as a profit center for retails is growing increasingly common. And then likewise, those same providers being broad and massive customers of the component level. So we thought that was a good third pillar to anchor our business in. We do work with many of the largest money managers, both public and private, in the world who invest in these companies. And that's important because it gives us an insight into A, what the industry is doing, but B, really where the money is flowing that should ultimately shape technology going forward. We also do work, with industry customers and provide critical business insights with what we call our fundamental research process. Literally, I spend my days, weeks, months, in Zoom Teams phone calls with people like yourselves, really trying to understand exactly what's going on in the industry real time, as Mike has mentioned. And then our reputation dates back well over 2 decades. And our technology team, we have north of 60 years experience of forecasting and analyzing the trends in the marketplace. So a long way of saying we've seen a few things in our lives. And then, why do people work with us and what we are to our customers? As mentioned, we are deeply connected in the industry. As I mentioned on the previous slide, we are a trusted resource for the investment community, both public and private. And then, as I mentioned, we are a critical partner, and we do work with all of the largest, or most of the largest, I should say, global technology companies. We work with them in multiple functional areas across the business, identifying the trends impacting their businesses, and then ultimately helping them in shaping their strategies to address and, more importantly, kind of capitalize on those opportunities going forward. This will be on the slide up, just how to engage with us at Edgewater, and then likely a little bit about myself. I started doing this in 2005. Have well over 10 years experience. I did take a little bit of a pause in the middle of my career, thanks to my loving wife, where I did a couple of different things in the insurance industry. But I've been blessed and fortunate to be back with the team at Edgewater since 2020. So I've done this a while. For those on the call, contact information's in the slide deck. The team at MSC Group will also, I'm sure, include this. Please feel free to reach out with questions or if you want any additional answers. So enough with the niceties. Where are we in the cycle? This is a question that we often get, both from our industry customers, but as well as our financial customers. And the natural first question it gets when the business peaked in October of last year was, how bad is this going to get? So in the chart, we've charted out at least the major corrections dating back to 2000. And when I cover some of the data, this includes all of the corrections back to at least 1990. And, troubling out of the gate, we were closely mirroring the 2000 correction, which I think anybody would say, boy, that would be really, really bad for business, because not only was it significantly deep, but also it was very, very long and took years ultimately to return to peak levels. So, the good news with it, and I think it's very, very safe to say, that scenario is really off the table, and I think you could ascribe to it that it's technology in general, or components in general, are much more pervasive in the markets that they serve now versus 2000. So now that we've gotten the worst case scenario, really, what does this correction look like? And the one that it's mirrored most closely is the October 11th dark blue line on the chart. And you could see how closely the sales or the decline in sales have tracked each other. But I think equally as important is what doesn't show up in the data and what drove us into this correction. So if you think back to the October 2011 correction, that really stemmed from the recovery from the financial crisis. So if you think back to 4Q08, Lehman Brothers files, the banks are a mess, everybody across the industry, and rightfully so, for this once in 100-year event, they all halt production, reduce inventory levels, et cetera, et cetera, et cetera. And what we saw then was that, yes, it was a very, very short, it was a very, very deep correction at the start of the financial implosion, but it also proved to be very, very short, and led to what amounted to roughly a 2.5 year to 3 year upcycle. And I think when you draw some similarities to what we saw around COVID, not making light of the human loss or anything like that, with COVID, we had a once in 100-year event. Of course, this one was health related versus financial related, but nonetheless, it was a once in 100-year event. The entire world shut down rapidly. And what we quickly saw in the COVID years is that while it was deep in that initial shutdown, it wasn't very long in terms of how long it lasted. So we entered into a period that lasted about 2.5 years to 3 years of significant lead time expansions, demand growth, et cetera, et cetera. So that takes us, really to the history. And I'm sure for everybody on the call, you're more concerned on when do we get out of the current inventory malaise that we're in. And, I think the good news with this is that it has proven to be somewhat of a shallow correction. So you're seeing ex-memory peak to trough sales hovering in that down 10%-ish range, which is the good news. So that, somewhat ascribes to the this is going to be a shallow correction. The bad news as we look at this is we think it's also going to be somewhat of a longer correction getting out. So when you look at some of the data behind it, you can see the major peak to troughs. While they've averaged 14%, this one is shown out to be 10. So again, it's 4 percentage points better than the median peak to trough, which is the good news. The challenge that we have, and really what's phrasing our thinking going forward, and I'll touch more about it in a couple of slides, inventory is still problematic across the supply chain from semis, interconnect suppliers, all the way through to distribution, EMS, and the end customer. So we still think there's a lot of inventory that's there to be digested. And then ultimately, because we didn't have a significant, rapid, sharp decline, we just think the pace of the curve will be a little slower coming out. So again, going forward, and we're measuring and thinking about this cycle being fully complete when we recapture and get back to that 100% level or peak sales on a monthly basis. History would guide us that we're probably looking somewhere in the 22 to 25 months. So call it really of a 2-year environment where we're below peak sales. So that would put us somewhere, probably in and around the fourth quarter of next year, before we at least surpass the high water mark that we saw in the upcycle during COVID. As we shift from the cycle and we look to the disruption, and I know many who have seen it, I think I may have used this the last time we did this. The COVID years, obviously, we had a significant level of disruption, from geopolitics to disasters to COVID outbreaks to boats being stuck in a river, material shortages. And if you thought that was bad enough, we might as well layer in a banking crisis that never really took hold, which, interestingly enough, Silicon Valley Bank, from an asset standpoint, was actually larger than Lehman Brothers. But as an industry, we've been able to kind of slough that off, along with the failure of Signature, Credit Suisse, and First Republic. We've been able to navigate through a financial crisis so far, but then on top of that, the last really strong market we had wasn't without, of course, its own challenges, as we've been working through, the strike between the UAW and the big three. While that looks to be somewhat resolved, I think it's still yet to be seen. The impact so far has been minimal. It looks like they have a tentative agreement, while again, there's still some plants or the votes at the plant level that hasn't passed through. So I wouldn't go around saying that it's necessarily done yet. But again, when you look back over this, call it 3-year window, this is a substantial amount of disruption. And despite that, our industry has shown itself to be quite resilient. As we shift from disruption and we move into the supply side of the equation, as I mentioned earlier with the cycle, the fundamental problem that we see in the industry is inventory. And as you could see on the chart at the top, this shows the inventory that we track. And I'll be the first to say this is a touch dated. We're in the 3Q reporting season that's kind of wrapping up next week. So this is a little bit dated of an information, but it tracks $270+ billion of inventory globally across analog suppliers, compute suppliers, comm suppliers, distribution, ODM, EMS, and OEMs. And as you can see from an inventory standpoint, the narrative throughout this cycle that quite simply we didn't have enough inventory was unequivocally false, right? Inventory dollars have grown substantially throughout the pandemic years. And there's a couple of things in the natural reaction is, well, Dennis, of course, this is related to price increases. And I would say, sure, we would agree with that to some extent, which is also why we look at it on a days basis, where days of inventory across the supply chain are still at a record level. So, when we think about it, the big problem, and I think the big challenge for the industry where we sit, and I have this highlighted in circle or squared with the box on the top, when we look at how inventory levels are relative to a pre-COVID basis or the last quarter before COVID, second quarter, I should say, before COVID, in total, we're 37% above 2Q19 levels on a days basis. Days include price increases. They are also a function of sales, where it's inventory dollars divided by cost of goods sold times 91. So, we're looking at an inventory level that's, call it, high 30% above. And you could see how it's broken down across the various categories that we track. I think there is some good news to this when you look coming into 2Q and beyond. We have seen improvements or moves at the ODM EMS level, which is good news. I will give the caveat that this does skew to like comm equipment and PC. But the people that are closest to the end customer, they've already taken the steps and they've been digesting inventory, which is some good news. And that's pulling down the total. It's flipping now to the supplier side where, they're starting to scale back utilization rates and things like that in the early part of this year and through the mid part of this year. So suppliers' inventory still look heavy to us. But again, if you're going to have the inventory parked somewhere, our preference from a health of the industry standpoint would absolutely be at the supplier level as opposed to in the channel or at the end customer level. With inventory, the natural question is, of course, how do we get there in terms of this inventory standpoint? And unfortunately for our industry, we just can't help ourselves. So when you look at 2020, 2021, and 2022, that was a 3-year window where our industry saw double-digit growth in terms of CapEx across the industry. The last time that had actually occurred was in 98, 99, and 2000, and unfortunately, we know how that ended. So as I discussed on the cycle slide earlier, the good news is the industry is a lot more diverse. It's a lot more real right now than it was in 2000. So we aren't looking at a 2000 level correction in our opinion. But again, the problematic move is unfortunately, sales over time in this business are a linear line up and to the right if you look at it long enough, and capacity is a step function. So we're in a position or an environment right now where there just will be time there will be time needed to grow into the capacity that's been added over the last three years. As we shift from the supply side and we move over to the demand side, I'll start with the PC market because I actually do think PCs are probably the best example of what's transpired in virtually all markets over the last 3 years. And the reason I like to use this as an example is we get clear industry data or unit shipments via a Gartner or an IDC every quarter. So when you think of PCs in terms of a historical run rate prior to COVID, it was roughly a 275 million type market, growing 5, 6, 7 million, declining 5, 6, 7 million every year. So again, we were in a slow growth, largely mature environment. That 275 or 275 million baseline went from 275 to 300 to 330 to 293 in a down year last year in 2022. So the net of that in aggregate over the COVID years, we firmly believe that the industry has pulled forward roughly 100 million units of demand. And I'm not saying we stuffed channels or anything like that. What I'm just saying is these were all future purchases that transpired in a 3-year window. And I think for anybody on the call, there's probably a very, very easy example at home to see. If you had 3 kids, one hypothetically was in kindergarten, one was in first grade, and you had an 8th grader, the 8th grader probably had a PC to work on their homework. During the COVID years, all of a sudden now you needed a PC for your kindergartner, you needed a PC for your first grader and your eighth grader, along with your PC at work, along with a PC at home. So that's what I mean by a pull forward in demand. So, that's looking backwards. What's it mean looking forward? We think this year we'll do somewhere in that 250 to 255 million. So roughly a 25 million digestion of that 100 million. As we look out to next year, we're thinking kind of flattish to slight growth. So again, call it 255 kind of best case scenario. So again, we're digesting another 20 or 25 million off that baseline. And we would expect the core PC market, again, to largely be relatively muted probably through 2025 as we digest the inventory levels. Now, the good news with that, at some point we're going to digest that pull forward and you have grown your installed base. So while we still think 275 is kind of your standard normal year shipment environment, you could see that, call it 5-6 million year over year, good year of unit growth. You could see that potentially go to 8 or 6 to 8, 6 to 9 million. So you could get a little bit of a kicker on the replacement cycle, but we don't simply subscribe to some of the supply chain participants that the new market for PCs is 300 million units in a given year. As we stay in compute, but we shift from PCs into the server market, really within server, it's a tale of 3 markets. So it's AI, it's data center, and then it's the enterprise. Starting with the easiest, the enterprise marketplace is still relatively muted, and that's being driven by a couple of factors. One, just an overall underutilization of assets during the work from home environment. So that's kind of an easy one to see. And the second one within the enterprise space or the on-prem space is just a broader overall macroeconomic concern. And that obviously stems from higher interest rates. It stems from inflation and things like that. At the end of the day, the cost of doing business for every company is higher. And then the justification that you need or the returns on any investment goes higher. So we think that's kept somewhat of a lid on the enterprise on spend on-prem space. When you shift over from that to the data center, very, very similar where you have the macro concerns, but and you have an underutilization story at play, albeit a little bit different. In the case of your major cloud or hyperscale providers, they do operate in a field of dreams model. So it is purely if you build it, they will come, where they build out significant levels of capacity. And then it's their jobs to fill the capacity. They hit a utilization rate and they start to expand again. So while there's no clear data on where we ultimately got with the build out, we've heard some estimates within various hyperscalers that they were in, call it the mid 65, 66% range, where the target that triggers investments, again, is closer to the 85% range. So again, not the end of the world, nothing really fundamentally broken with the hyperscaler market. They're just simply growing into the capacity that they've added. On top of that, shifts to one of the more exciting markets that we follow, being AI. I do think that is pressuring looking backwards at the hyperscalers. AI from a unit standpoint did 75,000 servers last year. The expectations are closer to 250,000 this year, and that's probably going to 400,000 to 500,000 units next year. So, we look at that explosion in growth in AI, and we don't see it as an and transaction for any of the cloud-based customers. It is simply an or transaction. So as we look at this year and next year off that base of, call it 11.5 million, I've walked through the numbers that we're expecting with AI. That's all coming out of your core server marketplace. So while the overall server unit number is still expected to be muted and probably will remain muted into 2025. We do think the AI market still offers significant opportunities. At this stage in the investment cycle, it really is kind of a rising tide raises, by and large, only one ship, being NVIDIA, who's the dominant content story there. But again, it is some level of goodness, and it is a market that's very, very exciting and still growing substantially. As we shift from compute and we look just at the smartphone market very quickly, I won't spend too much on this, but the smartphone market's been challenged this year, and that's really coming out of China. In China's case, there was a hope and a narrative at the start of the year that they'd rip the Band-Aid off on COVID. You get out of the Lunar New Year and they'd stimulate their way out of it. And really, ultimately, two things have happened with China here. One being they didn't stimulate, and two being the Chinese consumer really focused on, call it the soft economy, much like we saw throughout countries that emerged from lockdowns. They were more in favor of trips, shows, movies, etc., versus buying more devices or goods or stuff. So, I think again, the good news is the worst is behind us from a smartphone environment. We have started to see a seasonal order uplift in 3Q into 4Q, which is signs of that. Inventory at a component level does look much better. So, smartphones going forward is going to be much more of a lower growth than historical level, but you still do have a reasonable kick with the proliferation of 5G throughout the world. As we've moved from the consumer facing and look to the automotive market, this is our forecast for production globally through 2025. And I'd say if we look at 2023 in particular and 2024, it's really kind of a good news, bad news scenario. So our forecast at the start of the year was about 80 million units from a rounding standpoint, so roughly kind of flattish year over year. That was in stark contrast to some of our competitors that were more in the 84, 85 million range. I'd be the first to say we're ultimately going to get this right for all the wrong reasons. We had thought at the start of the year, you've got rising interest rates, et cetera, that would slow consumer demand. And what ultimately happened is the fleet sales really carried the day globally. And then, we've had some minor disruptions naturally from the UAW strike, and then more pronounced, we've seen production cuts out of Europe that have taken down the numbers, and you're seeing some of the others start to come closer to our number. As we shift gears and we look ahead into next year, we are seeing again low single digits, so we're about 81 million units, and I would give the one caveat: this is assuming somewhat of a status quo macro geopolitical environment. We know the geopolitics are obviously challenged with the Middle East and Ukraine. This is avoiding any significant escalations, oil embargoes, things of that nature. And again, barring any macro kind of implosion here. But really at the core of it, what we see is we're seeing a moderation, on the challenging side, or the glass is half empty side. Dealer level inventories are really replenished globally. That's a headwind for this year and heading into next year. There is still a fleet sales tailwind, but that will moderate after a relatively strong year this year. So we see that moderating from a production standpoint. And then, most recently, we have seen some volatility in the EV marketplace. And I'm sure everybody has seen that in the news as well. So again, we aren't expecting anything overly dramatic, slight growth for next year, but I would say bigger picture, long term. I think there was a narrative historically that at some point we're going to have to get to this mid 90, 95 range, 2017 in terms of global production. And the way we see it in the world, we're kind of a long ways off of that. So, we're expecting moderate growth from a unit or a production standpoint, which is good news. And then as you play it back into the component world, you've naturally got, an increased adoption of hybrid vehicles, which drives more content. You've got more electrification in the internal combustion engine, and EV will continue to grow, albeit right now the growth is really being only driven by two OEMs, Tesla in the West and BYD in the East. As we shift into the U.S. SAR, again, it's kind of a good news, bad news scenario, and I touched on a lot of it where, the bad news for this year, the good news for this year is on the top line, we're going to grow about 8% year over year, which is great. That is kind of where our forecasts were at the start of the year. That's where the forecasts, where we've tracked throughout the year. So we don't see really any risk here in the U.S., even including the potential disruption from the strike over the last couple of months. So that is, the good news. The challenging side with this, or the less good news, if you will, this has been driven by fleet sales. So fleet sales historically carry and continue to carry a relatively less premium vehicle, especially when you compare it to all of us as consumers that have been placed on allocation by the auto OEM. So we've had somewhat of a mixed trade down that has actually lowered the MSRPs across the industry this year. The good news, though, with that is discounting still remains relatively benign. Going forward, I think, again, you're going to be somewhere in that 15.3, 15.4, 15.5, so call it low to mid 15 range when it's all said and done for this year. And again, we're thinking somewhere in that, mid 15s for next year. So again, slight growth, barring no major economic downturn. The thing I think that we look at and we think about is what's the best case, worst case. And for next year, backing out a macroeconomic implosion, I think we feel pretty good that, the miles driven data is up significantly. So the fleet, meaning everything that's out in the marketplace, is obviously fuller. So that's something that should support a relatively stable environment. And then naturally, just the cost with the inflation, the cost with the potential for the new labor increases, and then ultimately, the lack of discounting will remain a headwind along with interest rates. As we shift that, I should say, before I move to the next slide, as we shift that from a consumer standpoint, and we do look at the impact from the UAW and how it impacts ultimately consumer orders. The UAW strike has impacted production, as I mentioned on the previous slide. But what this has really allowed is the supply chain to finish kind of that inventory replenishment. So we've seen it. The tier ones have been replenished, if not full. The tier twos were full. When you get into the threes and some of the subcons, the inventory was still pretty lean at a component level. And our view is most suppliers had used the opportunities or any of the rolling disruptions to replenish that. Unfortunately, as we shift into next year, we know within this industry, we never could quite get the inventory right. We're either always burning or building. So we do see some level of risk in the first half of the year from a standard issue inventory correction, most notably, I would say, within the internal combustion engine space. As we move out of auto and we move into the manufacturing side of the world, what doesn't show up in this chart is the inventory, and I'll talk about that in a bit. But as you look at just a top-down view of manufacturing in the world, we've clearly seen a moderation, and some of that's just simple math coming out of the lockdowns. And we did actually see it dip negative for a little bit before returning to kind of flattish over the last couple of months. Our view going forward, and I touched upon this a little bit, is I do think kind of structurally, assuming again a relatively quote unquote normalized macro environment, whatever that might be, we are thinking about this world in a sense where, growth rates might slow a bit, where, productions are kind of low, call it low to mid single digits. So call it 3 to 6% range. And then you have your content kicker on top of that. I think with interest rates higher and what we believe will probably be structurally higher for some time, we do think businesses evaluate CapEx projects and ultimately have to manage their investments tighter. So we think that caps some of the upside from a top-down view. When you look at our industry, again, whether it's electrification of the factory, whether it's energy efficiency, automation, robotics, those are all significant growth drivers, again, that we still think supports a long-term trend of call it 6 to 8% historically. With what I'm describing of the moderating or potential moderation for a CapEx, what does that 6 to 8 or 6 to 9 look like? Is it 5 to 7? Potentially. But again, we don't see a significant change there. The big catch to us, and I would point back to one of the earlier supply slides, is really just the inventory. And in particular, as we know, this business or the manufacturing or industrial base is largely sourced and worked through distribution, and the distribution inventory levels are still at record highs and still remain problematic and remain a headwind into next year. So again, as we look into next year, probably the first half of the year in the industrial economy, we're still burning inventory. And then hopefully we can get that cleared and start to see a resumption to growth in the second half of the year. As we shift from industrial and we look just quickly at the defense side, what I would say, and again, I want to give the quick caveat, not making light of any of the human lives lost in Ukraine, same thing with the Middle East. I think while it's been a narrative and a story in the news and how this has dramatically shifted defense spending in our industry, I think if you look back at this longer term, really the disruption or geopolitical tensions have not changed much in terms of overall defense spending or manufacturing. And if you dig a layer deeper and you really dig through Pentagon budgets and things like that, the budgets are really pointing to the war of the future. And unfortunately, the view is the war of the future potentially is fought over the Pacific, involving cybersecurity, cyber warfare, hypersonic missiles, etc. So, as you look at the long-term trend within aerospace and defense, we still think it's a healthy marketplace. Our armed forces and our projects will continue to be digitalized. So, again, we do think that continues to support somewhat in that, call it, mid-single digit growth for the foreseeable future. Now, just to shift from a high level view, so what does that all mean when you boil it up? And I know I've covered a lot there. So, this is using the WSTS is the history of the actuals. We've got 2023 down 12%, and that does include memory, which our memory number is down 25% as a proxy. If you were to back the memory side out of the equation, that number is closer to 5 or 6% range, which again, when you look at the cycle, really scribes to that this is somewhat of a shallow correction. I think where we ultimately differ from a lot of our peers or a lot of our competitors is our outlook for next year. And in particular, I saw one yesterday calling for 20% year-over-year growth next year, and it's something that simply we don't see in our marketplace. We think the inventory overhang is going to take at least another 6 months into next year, so 8, I guess, if you want to include the whole month of November. So really, we're not looking at any material improvement in bookings till probably mid 2Q at the earliest, and when you cycle that through mathematically with the inventory, it's hard to get above a low single digit, call it 2% type growth for the year. And again, we work through the inventory and we get back to 2025, and our number again goes closer to the 7-8% range on the high end of that history, which we think just reflects some of the slower growth or the declines that we've seen over the last couple of years. As we shift from semis and into the interconnect space, I would tell you the story is very, very similar, with the only caveat being, we do see a more shallow decline, being 5% this year, and that's really based on the interconnect suppliers. We're not as prolific with the non-cancelable, non-returnable programs, so the inventory is not quite as bad. But again, we're seeing low single-digit growth next year, and again, when you get out into 25 into 26, we're thinking it's kind of in that 5-ish% range, driven on the backs of automotive, driven on the backs of AI. the delta between this and the semiconductor industry is really, the semi industry with new product introductions has the ability to take more price or charge more price. So we do think that gap is largely price driven between the two. Lastly, from a passive standpoint, I would tell you this is the area that we're most concerned. And our outlook kind of reflects it. So we're down 8 for this year. More importantly for next year, we're flattish for next year off, relative to a couple of points of growth. And I would tell you there's even potentially some risk within that. And really the risk is purely price driven. There's a growing willingness across the major passive suppliers to engage in more aggressive pricing, and we do see that as the biggest risk in 2024. So just to wrap up, a couple of things that we're watching closely here. We are watching AI, these LLMs, and what do they mean? And they've gotten a lot of press, and rightfully so, and they've helped stabilize the industry. But at this stage, the network architecture hasn't been figured out. The monetization has not been figured out, nor has really the investment cycle been figured out. So we are really, I would argue, at peak in terms of the hype cycle within AI. I think, if you do look at AI relative to the last big thing, meaning the metaverse, like this hype is real. There is some utility. There is some utility within, not some, a lot of utility within AI. But again, right now it's kind of an arms race where you're seeing a number of hyperscalers that are spending billions of dollars, and it's purely on a FOMO basis or fear of missing out. It's always top of mind for us with the China trade war escalation. What does this mean? It's been very, very tit for tat. I think it's clear that everyone would agree. Neither anybody wins, but again, it's above my pay grade and arguably intelligence level to understand the national security concerns and balancing those relative to the potential disruption. But it's problematic nonetheless. We do, and I'm sure everybody on the call would agree, the number of TC+1 or China plus one strategies continues to grow. Unfortunately, a bulk of our production is there, so I don't see an easy way out. Talked a little bit about the inventory. We went from, just in case, or just in case to, or sorry, just in time to just in case to just too darn much. When we get on the other side of this correction, what is inventory? My bet would be that we go back to exactly the way it was. We, in many things, are not part of the camp that subscribe to a new normal. We feel that normal will be what normal will be. But again, where ultimately it settles out will be interesting to watch. And again, I talked on it a little bit. We're just watching competition, pricing, second sourcing, especially when you get into markets like industrial, markets like automotive, where typically those have not been second sourced. So with that, what questions do you guys have? I know I covered a lot there.
Dennis, you absolutely did. Thank you so much. We don't have any questions right now. But one thing that comes to mind, in June we talked a little bit about the move to production outside of China. So finding those options in other countries. Are you seeing that still at this point?
Yeah, absolutely. And I'm gonna pull something up here. Those conversations are very, very much in play right now across a number of customers, and I think in every market where it's what is and there's various terms, buzzwords, individual company slogans, if you will. Whether it's the TC+1, whether it's just China plus one, whether it's supply chain resiliency, there's a whole there's a whole host of those. So that has not gone away by any stretch. I think the challenge, and with some of the customers that we've worked on specifically, the real challenge with this is ultimately what can you do in terms of, and I'm going to pull up a slide here. What can you do in terms of actually offsetting the China impact. And I'll start here. So, if you just look at maybe I'll skip one here. If you just look at, foreign direct investment over China since they've entered the WTO, it's amounted over $4.4 trillion, right? So there has been, close to 22 years of making China the manufacturing capital of everything in the world. So, while some of these customers, are looking for quick fixes, unfortunately, there really isn't one. I think you're going to measure this in years, if not decades, if we do go that far. Two, within that, if you break it down a little bit, this is your foundry market share. So TSM, Taiwan Semi makes up a bulk of it. UMC is also Taiwanese based. So the idea of eliminating Taiwan from your supply chain becomes problematic. And then, by country, again, we're looking at close to 72% of semiconductor or foundry share is in China or Taiwan. So, it's a long way of saying, well, I certainly understand the customer's view and they want the resiliency plans, and I could walk through a bunch more of the number of fabs and everything else. When we walk through all of that information, unfortunately, there's just not a realistic problem. And if you do want to move, in most of the conversations that we've had, if a semi supplier just wants to move their back end out of China and, let's say, move it to Mexico or Malaysia or something like that, in some cases you're looking at a 500 to 600% cost increase to make that move. So you're in an environment where OEMs are asking for pricing to go back to pre-COVID levels, which in some cases could be as high as 40% above where it was in 2020 or 2019. And they're also asking you to move your production, which has a 500 to 600% cost increase just on the back end. So, long way of saying that, while the conversations are still very much happening, we just unfortunately do not see an easy solution, and think, going back to that questions or concerns on geopolitics, I think both China and the US, to borrow an old cliche, we've just got to find a way to play nice in the sandbox with each other.
Absolutely. We do have one other question. Do you have any insights on interconnect growth, 23 over 20 or for 24 in US shipments?
Oh, in US, yeah. So, that's the global number that I ran through. So when we think, of the US market in 23, we're thinking it's going to be somewhat in line with kind of the global marketplace, maybe a little bit, actually a little bit better. So we think the weakest area is APAC, or in particular China, within APAC. But when we go to next year, if we're thinking kind of low single 2-3% growth globally for the interconnect marketplace, our expectation would be, the Western world in general, including Americas, would be kind of in line or maybe even a touch below that. Call it flattish to up slightly, where a bulk of the growth we think will actually come out of APAC. And that's purely based on the fact that the declines were much more significant this year than they were last year.
Sure, thank you. And then another question came in. Do you envision a recession next year? And if so, does that change your forecast by much?
Yeah, great question. And I'd be the first to give the caveat. We're not macroeconomists, so I don't forecast GDP growth or anything like that. And that's not to say we don't pay attention to it as well. But, that's not the core of what we do at Edgewater. So, while I won't directly answer the recession, I do think, in terms of how we operate at more of a micro level, which is where we focus, I do think there's somewhat of a significant overarching macroeconomic pressure, and that's mainly from the standpoint that inflation is problematic, one, and that leads to interest rates being significantly higher than they've been over the last 3 or 4 years. So, when we move that back, and you think of any industrial, or really any business overall, their investment, their overly simplistic view is when they look at their investments, they want to make sure their return on investment capital outpaces their weighted average cost of capital. The weighted average cost of capital is based on the risk-free rate of return, which is typically U.S. Treasuries, and that's gone from effectively 1% to like 5%. And then you put on the risks of the individual business. So again, the returns that are needed on any investments are significantly higher, and I think that's the area that we're focused on more so than necessarily a recession, versus not a recession.
Sure, thank you. Can you comment on the NCNR situation created by limited supply and how companies are handling it?
Yeah, so it's I would say there's three buckets, if you will, or three strategies that have happened, and I'll keep it in the semi-reign where they were the most prolific. There's strategy one, which was from the likes of Texas Instruments, where they really didn't deploy non-cancelable returnables. As everyone I'm sure on the webinar knows, they also don't engage with distribution overly closely. So when you look at their correction through this, I would actually argue they're probably the closest to quote unquote real end customer demand. Their correction started in 4Q22, and they were the first with no non-cancelable orders. When you go into kind of a bucket or a category two, suppliers that come to mind are like onsemi or analog devices, or suppliers like that. And there are others, not just to pick on those guys. They had non-cancelables, they had LTSA programs, but they did offer their customer base some flexibility. In the case of like an analog devices, they started allowing cancellations in 1Q of this year, and their correction actually hit more in the summer months of this year, and it continues now. So it hit later, and it's probably going to extend into 1Q and 2Q, where TI will probably show that they're coming out of it. And then there's kind of a third bucket with the non-cancelables, and that's the likes of like a Microchip, or Infineon was a little bit more aggressive, or NXP, some of those guys. And again, there are others, not just to pick on those guys. Microchip finally, they're forecasting their business to decline 15 to 20% sequentially in calendar 4Q, which is, in our opinion, a direct reflection, because it's the largest quarter-over-quarter growth of anybody that we follow. That is largely reflective of the fact that for the last, call it 12 months, they've continued to ship to non-cancelable, non-returnable, and those programs are running its course. You've seen others that it hasn't hit yet. So, it's a long way of saying that the non-cancelable, non-returnable programs are kind of running to an end. I think it's a good theoretical question when we get on the other side of the inventory correction. I think it's egregious personally for the industry to demand 12 to 18 months of non-cancelable, non-returnable orders. I don't think it's good for customers. I don't think it's good for distributors. I don't think it's good for the rep community. I don't think it's great for the suppliers, because they have guarantee, but really they're just kind of extending any weakness. So, could we see more of that kind of middle tier bucket as we emerge from that? Probably. I think there's a place where that non-cancelable window maybe extends beyond 45 days and gets to 90 days or something like that. But again, that's kind of how we're thinking about non-cancelable, non-returnable programs going forward.
Thank you, Dennis. Do you have any thoughts on how the election might impact the EV direction?
It's a great question, and I've done a number of presentations, and I've thought a great deal about EVs, and what ultimately I ground myself on is there's really two EV OEMs that matter right now. It's Tesla and BYD. Taking BYD out and whatever China's motivations are, if you look at why Tesla is really the only EV OEM that matters in the West, They are successful because, one, they were first to market, two, they drastically altered the manufacturing process, but three, and most importantly, they just build really cool cars that people want to buy. And once they hook somebody in, they tend to be repeat customers because stuff just works, to keep it with a real technical term. So, as I think about that backdrop with, the direction of, a potential change in political party in control or in the White House, I often subscribe to governments could set whatever targets and or emission standards they want, but I don't think that actually moves the market unless you build really cool cars that consumers want. And I think, that's the fundamental challenge when you see, you compare Tesla's relative success with, again, not to pick on a General Motors, but General Motors last year did $168 billion in global sales. In my estimates, roughly $2 million of that is in EVs, and they plan on spending $35 billion in EV R&D plants, et cetera. GM, with where their program is, should shut it down. They should focus on building cars that consumers want. They should funnel the R&D, in my opinion, into a more fuel-efficient internal combustion engine, into more hybrid offerings, because what's clear is nobody wants their EVs.
Yes, it is. One last question. Do you have any thoughts, or do you have numbers for the electrical mechanical growth 23 to 24 in the US? And also, do you have thoughts on the impact of the golden screw that holds up the production going forward?
Yeah, unfortunately, we haven't really fully built out the electromechanical. That's something, that we need to continue to work out. So I don't think I have anything that I could really add a value there. From the golden screw scenario, our stance, it's never fair to say there's no such thing as a shortage everywhere, because there's always, again, you take somebody like TI as an example, they have 75,000 part numbers that they sell to 100,000 customers. There's always something that could be problematic, but by and large, from a golden screw standpoint, those are largely over. And if they're not over, I think the onus is going to have to fall on the customer, because those are quite simply parts that supplier ABC is no longer willing to support. So I do think early in this shortage, I had a train of thought that's impossible to measure or find data, but I think this will ultimately prove to be one of the bigger product, quote unquote, rationalization we've seen out of the supplier base of really moving people to different products. And there's various suppliers you could point to that have done that. So I think, if you are seeing a golden screw right now in a lot of cases, I don't think that's going away anytime soon. I think it's really the supplier's way of saying, we're either A, not going to support it, or B, we're going to only manufacture X number of units. Our lead times are always going to be 50 weeks, and kind of get in line. And when we're done with that run, there's no more.
Thank you, Dennis. Mike, did you have something you wanted to say before we wrap up? I think we might have lost him, but Dennis, thank you so much for your time and this great insight. We appreciate you always being with us every couple times every year, and we'll look to do this again next year as well. And also I wanted to thank all of the participants today. We will be sending out the recording and the slide deck to everyone in the next few days. And please do look for our FasTech seminar series events over the coming year. I hope everybody has a wonderful day, and thank you again. Take care, Dennis.
Thank you, everybody. Have a great day. Thank you.